Hello, my name is David Fisher, and this is my presentation for Finance 381 at Southeastern Louisiana University. For this project, we were assigned to analyze three different companies. The three companies I will be analyzing are Exxon Mobil, an international oil and gas company, and two local utility companies, Entergy and Cleco. First, we're going to analyze these three companies on a short-term basis. For a short-term loan, the example given was a substantial loan that was going to be paid back in a 6-month time frame. Second, we're going to look at a long-term loan that's going to be paid over a 5-year time frame. And third, which company would I prefer to invest in if I had the capacity to purchase a controlling stake in that company. So first, let's begin with the short-term analysis. Here we have the current ratio comparison of the three companies, and Cleco stands head and shoulders above both Entergy and Exxon for the last 4 years, and their current ratio has been increasing over that time period. Their current ratio in the most current year is over 2, whereas Entergy and Exxon hover around 1, which is a pretty significant difference. And if this was the only ratio we were going to use, Cleco would be the clear winner. However, as you'll see as we go on, a lot of that ratio is built on inventory and not other things, especially cash, which is what we're looking for in a short-term situation. Immediately as we go to the quick ratio comparison, removing inventory from the equation, Cleco drops below Entergy. This tells you that quite a bit of Cleco's current assets that they maintain are in inventory in comparison to Entergy. Exxon again is bringing up the rear, and for this particular episode, for the short-term loan, it appears that they're ruling themselves out of the competition. The cash ratio comparison, which is the one that I'm most concerned about when we're analyzing these three companies and their ability to pay off a 6-month loan. Entergy is far ahead of both Cleco and Exxon. As you can see here, Entergy almost triples Exxon's cash ratio and nearly doubles Cleco's. So for the short-term choice between these three companies, for me, is Entergy. Now let's move on to the long term. The long term, we're going to use two ratios. We're going to use time interest earned, and we're going to use the equity multiplier. For this, we're using this big long chart. I'll pop it up here on the screen for you to see. But I want to draw your attention to the times interest earned of Exxon. Their times interest earned over the past 5 years has been consistently over 100, whereas Entergy and Cleco hover between 4 and 2. In terms of their liquidity, Exxon has been much more conservative than both Entergy and Cleco. Cleco has maintained an equity multiplier around 3, although that equity multiplier has been decreasing, whereas Entergy is maintaining a very high equity multiplier in excess of 4, meaning that for every $1 in assets that they own in equity, they're probably going to have another 3 that are owned by somebody else, that are liabilities. ExxonMobil has been significantly more conservative, as I mentioned before. Their equity multiplier has hovered right around 2, which means that for every $1 they have in assets that they own on the equity side, they have about $1 in assets that are in liabilities. So for the long-term comparison, Exxon's superior ability to pay their interest year over year, combined with their lower leverage ratio, means that for me, ExxonMobil is the clear winner for a long-term loan of about 5 years. Now let's move on to the equity side of things. Which company would I like to invest in? We will begin with what has been described to us in class as the single most important ratio, which is the return on equity. As you can see here, Exxon is the clear victor in return on equity. The return on equity has dropped some, but it hovers right around the 20% mark in the past 2 years, which is over double what Cleco and Entergy have been doing over the same time period. All three companies have declined somewhat from 2010 to 2014, but the decline, especially of Cleco, has been more significant. Their return on equity has decreased almost in half, whereas Exxon's, after peaking in 2012, has come down about a quarter. Let's break up return on equity into the main components. The equity multiplier, as we discussed previously, this is an area where myself, I very much prefer Exxon. Their equity multiplier is low. They have less tolerance for risk than both Cleco, which is a little higher, and Entergy, who has maintained comparatively a significant amount. They've been significantly leveraged over this period of time. Quite a bit of their assets are liabilities, not owner's equity. Shareholders' equity, would be better to say. Now, as you can see, when we look to return on assets, Exxon continues to pace the field. Their curve looks very similar to what we were looking at when we talked about their return on equity, whereas Entergy and Cleco lag behind. Let's look into what is pushing this. It isn't profit margin. Cleco and Entergy have had consistently superior profit margins to Exxon over the past 5 years. That surprised me when I was first digging into it, because I expected that since Exxon had such a better return on equity, that they would have at least a comparable profit margin to both Cleco and Entergy. However, as we look here, the problem is the efficiency of assets for both Cleco and Entergy. Cleco and Entergy, you can hardly see it here. It almost looks like a McDonald's line with the red and yellow overlapping. They hover right about 0.3. Whereas Exxon's, while it has been declining, has sustained above 1. So they're significantly more efficient with the assets they have, even if per dollar of sales, they have not been quite as efficient. The last thing we're going to look at here is the price to earnings ratio. For me, I like the fact that Exxon's price to earnings ratio is lower than both Entergy and Cleco, because that means that for every dollar it's going to cost to purchase equity into this company, they're actually returning more on sales. And as we saw previously, they're also returning more on equity, which is impressive when you consider the fact that Exxon actually owns more in equity than the other two companies. Both Cleco and Entergy have a much lower percentage of their assets which are owned by their company, as we can see from the equity multiplier. So, Exxon's combination of superior return on equity, superior return on assets, superior asset turnover, total asset turnover, and their superior price to earnings, since we would actually like that to be lower rather than higher, making it a bit of a bargain for an investment strategy, I would prefer to invest my money in Exxon Mobil. Thank you very much, Dr. Cresson, for this opportunity, and I look forward to seeing you again soon.